Okay, and welcome back, students who are taking financial accounting. And in this series of videos, we are working on the theory for Chapter 10, which is on corporations, paid-in capital, and retained earnings. And so far, we had covered in previous videos how a corporation is organized. We had talked about when it's organized, the creation of common stock and preferred stock, and then we talked about dividends and how the dividends are divided amongst the common and preferred, and using the ideas of cumulative and non-cumulative. And then the last video we talked about having dividends as stock dividends instead of cash dividends, and we talked about stock splits. So in this video we are going to talk about what is treasury stock. So let me jump down to the treasury stock slide here. Okay, and I'm going to be using the numbers from the book because they're relatively simple, and the idea is relatively simple. The treasury stock is not that complicated, although it's kind of strange, but when you think about it, it makes sense. With treasury stock, what you have is you have your outstanding shares of stock, whether it's common or it's preferred. Okay. And to keep things simple, I'm not going to muddy the waters with the preferred, all right, even though it applies just as equally as common. So I'm just going to talk in terms, thinking in terms of the common stock, because again, it doesn't matter which one it is. Okay, so you have these outstanding shares of stock, all right, that's sitting out there, and let's just say, you have 500,000 shares that are outstanding. Right? Now, since they're out there, it doesn't mean that once they issue it, they float out there forever and ever and ever. Okay, no, those shares of the stock have to come back to the company. When they come back to the company, they come in what's called treasury stock, meaning the company goes out and it buys back the stock, right? So the company is able to purchase the stock, and when they purchase that stock back, whether it's common or preferred, they call it treasury stock. Okay. So now we're thinking in terms of the stock that the company has bought back. So we have the issue of purchasing it. Okay, and when they purchase it, so this company has this treasury stock, but we when they have the stock, it still is not retired. Okay, retired meaning no longer exists. Treasury stock still exists, so if the company buys it back, it is still possible for them to sell it back into the marketplace. Okay, and put it back in, put it back out there. However, if they decide not to do that, they can decide to retire that treasury stock. And so if we started out with like 500,000 shares, and the company decides to purchase, say, 500 shares, and I'm using the numbers from the book, okay, but I'm just picking the 500,000 here as a number out of my head. That's kind of like been the theme for this chapter. Well, now the common stock will only have 499,500 shares left, right? That's the 500,000 less the 500, right? So they'll have common stock of 499,500 shares, okay, available. That will be their common stock, because now we have treasury stock of 500 shares. So our total outstanding, all right, started out at 500,000, but now we have the 499.5 in common, and for treasury we have 500. So they total that outstanding amount of 500,000 shares, unless we retire it. Okay, if we retire those 500 shares, then our outstanding stock is no longer 500,000. It's the 499,500, because we've gotten rid of the 500 shares. So that's kind of like the idea behind this. Let me So to keep things in a little bit clearer example, we have outstanding shares, a total of 500,000 out there. And the company decides to purchase some of those shares back. And when they purchase it back, they purchase 500 shares. Well, those 500 shares are now treasury stock. Okay, these 500,000, we're just going to call them common stock, but it could be common or preferred. Okay, so now our outstanding shares are 499,500 shares. And on our balance sheet, right, our common stock will change, right, and it'll be 499,500, right? I'm sorry, my outstanding is not that. My outstanding still remains at 500,000. Sorry about that. But the change is in that instead of having 500,000 of common stock, now we only have 499,500 because we have 500 in treasury stock. So we still have the same amount of outstanding shares. Now, we can take this 500 shares of treasury stock and we can sell it back into the marketplace. Okay, if we do that, all right, well then we no longer have that treasury stock because it's back out in the marketplace, and our common stock, our outstanding shares of common stock will then become 500,000. All right, so we're still maintaining the 500,000 outstanding shares. It's just a matter of we took it out of the marketplace and we put it back into the marketplace. Okay. If we go and we say that we're going to buy those 500 shares of treasury stock, okay, our outstanding number of shares still stays at 500,000, but the common stock will be 499,500. Okay, so we're buying the 500 shares. Now, instead of selling it back into the marketplace, we decide we're going to retire those shares. Okay, and if we retire those shares, okay, there's no longer the treasury stock of 500, right? And our outstanding shares now is only the 499,500, right? That's when we retire some of that treasury stock. Okay? So what does this all look like? Right, from a journal entry perspective, okay, when we're going to buy the stock, obviously we're going to debit our cash because we're paying for it, okay, and oops, I'm sorry, not debit our cash, we're going to credit our cash. Oops. We're going to credit cash because we're paying cash out, and that means we're going to debit our treasury stock. Right, that treasury stock is an account in our equity section, right? And if we're going to buy 500 shares and the market value is $25 a share, okay, that means we're going to pay out $12,500 in cash, $125,000 in cash. 5,000 shares. There we go. Yeah, get this right. All right, yeah. I know what I'm doing. I'm looking back and forth in the book, and I should have used the example of 5,000, but that's neither here nor there. But anyway, so we're going to decide we're going to buy some of that stock back, and we're going to buy 5,000 shares at $25 a share because the $25 is our market value. So we're going to pay $125,000 in cash, and we're buying. Our treasury stock is going to have $125,000 worth of stock in it. Okay. Now, that was the purchase of the stock, and according to the book, all right, we're going to sell some of that stock back into the marketplace. Well, when we sell it back into the marketplace, we're going to debit our cash, right, and we're going to credit our treasury stock. Right? And in this case here, they're selling 500 shares back. Okay. Well, when they sell the 500 shares back, we have to consider what the market price is. If the market price is $25, which is what we originally paid for it, okay, then all we have is, just the change in the treasury stock itself. So 500 shares at $25, when we sell it back, is $12,500. Okay, and that puts those number of shares back into the marketplace. Okay, so now if we were looking at it from the perspective of we had 500,000 shares outstanding, okay, and we bought back, so this is common stock and it's outstanding, and if we bought back 5,000 of treasury stock, okay, our outstanding number of shares would still be 500,000, okay, but our common stock would not have 500,000, all right, it would have 495,000, right? The number of outstanding shares stayed the same. Now when we go and we sell back into the marketplace 500 shares, okay, well now our common stock, our treasury stock, doesn't have 5,000 shares. It has 4,000. Let's see, no, 4,500 shares. Okay, and our common stock now has 495,500. Okay, we didn't retire any of that stock, so our outstanding number of shares still stays at 500,000. Right? Okay. Now that's relatively simple. Okay, and we'll talk about retiring these number of shares in just a moment. But before we do that, we have to consider that when we bought it at 25, and when we're selling it at 25. But the price of the number of shares doesn't always stay the same. The price of the shares can go up and the price of the shares can go down, all right, when we decide to sell it back into the marketplace. So if we, if we buy the shares and the sale price is above our cost, meaning, we just had 500 shares at $25, right? I'm sorry, we bought 5,000 shares at $25, right? What happens if we decide to sell the 500 shares back into the marketplace, and instead of selling at 25 like we just did, the price of the shares went up to 28? Okay, well now we're going to have an excess of capital because our cost is 25, right? And we're going to get $3 above what we actually paid for it, right? So the journal entry is, the thought process is just the same as common and preferred in that we have a paid in excess, right? We have a paid in capital, right? So we take, we're going to get cash, right, of 500 shares at $28, all right, which is $14,000. Okay. We're going to credit our treasury stock, right, and that is going to be for $12,500 because that's what we paid for it, right, in our last journal entry. And of course now we're going to credit a paid in capital, right, treasury stock, right, and the difference between the two, right, difference between those two is $1,500. Okay. So that is the journal entry we make when we're selling the stock the treasury stock back into the marketplace at a price that's higher than what we actually paid for it. The difference between the two being the $3. And again, just like you saw in the last video, you can figure out this paid in capital in two different ways. but it's easier just to, since you have to do this calculation for the treasury stock, it's easier to just back into the number, back into this paid in capital amount by taking the difference between your debits and your credits, right, to make the journal entry. Right? So that's how that journal entry looks when we're selling it over cost. Okay. Now, it's just the opposite for when we're selling it below cost, right? So let's say, remember, this is our cost over here. So let's say we're selling the, let's see, what did they use? They decide in the book, for whatever reason, they decided to sell 1,000 shares, but now instead of selling it at $25, they're selling it at $24, right? So our cost was 25, so now we're selling it for a dollar less than our cost. So we're still going to get cash, right? Because we're selling the stock back into the marketplace, but 1,000 shares at $24 a share is $24,000, right? Of course, we need to take it out of our treasury stock, right? So we're going to credit, we're going to credit our treasury stock for the $25,000, right? Because we're selling 1,000 shares at our cost of $25, right? 1,000 shares at $25 a share, which is our cost. So that's $25,000, right? And again, we can sit down and we can calculate the paid-in capital, but why do that when we could just look and say, okay, our debits have to equal credits. This should be a debit, not a credit. Our debits have to equal our credits. So, I have to debit my paid-in capital, treasury stock, for the difference between the two of $1,000, right? I just need to look and say, what's the difference between debits and credits? And I back into that $1,000 amount. I don't have to go through the mathematical gyrations of calculating that 1,000 shares at 1,000 shares times the $1 less. Remember, because we have to do one additional mathematical calculation here to get the $1. So I'm actually being more efficient, saving time, and have less chance of an error by just taking the difference between my debits and credits and backing into it, versus having to say, okay, I had 20, I bought it at 25, I sold it at 24. That means I have $1 loss. I have 1,000 shares at $1 loss is $1,000. It was more simple. It was easier to say 25 less 24 is 1. Okay, so that's how you record the sale under cost. Okay. So now those shares, so what we just looked at, to quickly recap, because now we're going to talk about retiring. What we're recapping real quickly, we had outstanding shares of stock, common stock, or preferred, whatever. We decided to purchase the stock. When we decide to purchase the stock, that becomes treasury stock. So our common stock plus our treasury stock is still the number of shares that are outstanding. Okay, but now instead of having all of our stock out there on the marketplace, we've bought back some of those shares and taken them out of the marketplace, and we call that treasury stock. Now, when it's in the form of treasury stock, we have two choices. We can either sell it back into the marketplace, or we can retire it. Right? If we decide to sell it back into the marketplace, we can sell it at cost, which you saw the journal entry before I erased it, right? Go back and watch the video again. Or we can sell it over cost, or we can sell it at under cost. And, to be honest with you, you're more likely to sell it either over or under, because the marketplace changes, all right? It's rare that you're going to actually sell it back at cost. Why buy it at $25 right now and then 2 minutes from now sell it back at $25. No, you're going to buy the stock back today, and by tomorrow the price has changed, right? And with that change of price, you're going to sell it either over or under. So what this does is, as a quick aside, is this allows the company, right, to be able to buy and sell their shares of stock, right, and make money on it, right? I mean, a company can go and buy and sell shares of another company, all right, to try to make money off of it, right? And we see that as in our assets section as marketable securities, right? As marketable securities in our assets section when they're buying, shares of another company. And they can buy those shares and sell those shares and try to make a profit off of it. But the corporation can do the same thing, with their very own shares. Okay, in that they first want to, they authorize the shares and then they sell the shares so that they can get cash into the business. Okay, but that puts shares of stock out on the marketplace. Right? So they're getting the cash in the business to do whatever they need to do. And then these shares are still floating out there in the marketplace, and the price is either going up or the price is going down. And the company can go out into the marketplace and buy back their shares of stock, okay, and speculate on the price of shares going up and down, and that's their treasury stock. And so they can buy it and sell it, trying to make money off of the appreciation or depreciation of that stock price, right? Just like they do with the marketable securities, right? But once they've decided that they no longer want those shares out there due to financial analysis or whatever have you, it's how they want to present the business in and of itself. They can they can retire the retire the treasury stock. Okay, and if they retire the treasury stock, if they retire the treasury stock, okay, what they're doing is taking it out of the treasury stock account, okay, and they're putting it back to where it originally came from. And what's that? Retained earnings. All right. So the journal entry for doing that has to take into consideration not only the treasury stock, but the paid-in capital account, okay, for the treasury stock. And in the book, they give the example, and that's why I didn't like this example of the book, because originally they started out with 5,000 shares that they're buying back. They're selling 500 back into the marketplace. Now they're retiring 1,500. They're using different numbers, and I can understand why they're doing that, because you do have to realize that you're not talking about cookie cutter here, okay? But in our examples, as we were going through, it was 5,000, then 500, now it's 1,500. So, and they're taking this 1,500 and they're saying, okay, we're going to buy this treasury stock and we're retiring it at the same time, all right? Whereas I think they should have just gone and said, okay, let's just retire 1,500. If you're retiring, and let me just veer from the textbook just for a moment, okay? If we have the treasury stock, okay, and let's just, and I'm setting up a scenario because this is not in the book. Let's say there's $15,000 just in the treasury stock account, and I'm not considering paid-in capital here, right? So if there's 15,000 in treasury stock, all right, and let's say actually let me make that look like a T account, because that's what accountants do. They use T accounts. There's 15,000 in our treasury stock, and for retained earnings, let's say there's 100,000 in retained earnings. Okay. If all we want to do to retire the treasury stock, well, all we want to do is just move it from treasury stock into retained earnings. So to do that, we would debit the treasury stock for the 15,000, and we would credit retained earnings for the 15,000. And so that means when we post the journal entry, we would have 15,000 here, so our balance would be 0. We have 15,000 here, so our balance would be 115,000. Okay, so all we did was we moved it back into retained earnings. That's it on the most simplest level. Okay, now notice I didn't take into consideration the paid-in capital. Depending upon whatever's in the paid-in capital, I could do this. I have to do the same exact thing, all right, and make that part of that particular journal entry. But instead of creating another example there, I'm just going to go and use what is in the textbook at this moment in time in saying that, I'm like jumping over a step here, in saying that we're going to buy, so we're going to debit our cash for 15,000 shares at $22, right? So we're going to get $33,000 in cash, right? We're retiring our treasury stock of 15,000 shares, and that treasury stock was at $22, $25, right? Because we bought it from the marketplace at $25,000. I mean, at $25. So we're going to credit our treasury stock for the $37,500. Now, the difference between the two, all right, is our paid-in. Well, I can't say the difference between the two. The paid-in capital ends up being the $1,500 less than $1,000, or $500 in paid-in capital, and the difference between the debits and credits goes to our retained earnings of $4,000. Now, what is it that we did here? Okay, what we did was we said, okay, the difference between our cost and the selling price is $37,500, okay, less $33,000, or $4,500, right? In following the example in the textbook, we had in our paid-in capital account, and they show that the T account for that, where the balance in the paid-in capital account was had a $500 in there. Okay, so we end up having to debit the paid-in capital for the $500, right? And the difference between those two, between our debits and credits, now goes to retained earnings, or of the $4,000, right? So this ends up being our journal entry, right? See, I'm struggling here in that I'm thinking about the way it's being presented in the book versus the way I would work through it. Okay, so I paused the video just to take a look at what was in the textbook in and of itself, and I said I would, remember, I'm doing this out of my head. I'm not following the book scripted, okay? I'm trying to give you an understanding of how I'm thinking about it, and as I'm going along here, I understand what's happening in these transactions, but what I was failing to do was, even though I was using numbers out of the book, for this reason, they decided to take and say, okay, we're going to purchase stock, treasury stock, we're going to sell above cost, we're going to sell at cost, we're going to sell below cost, and they kind of made the example in the book, or this section in the book, cumulative, meaning they started at one point, they had all of these transactions, and all of a sudden they're going to retire some stock, and they're arbitrarily picking 1,500 shares here. So kind of follow what's in the book, okay, and work through the numbers and see where they're all coming and going from. As I presented the information here in this video, realize that the journal entries I was showing you and the thought process behind them all applies. The point and it comes in here as to when it's retired, and in this case here, they're retiring and actually selling at the same exact time. Okay, which is a little bit more complicated, right? You could, in doing this, you could have made two separate entries, and honestly, that's the way I would do it. I would not end up combining it, and this is probably why, as I'm talking through this and I'm thinking through this, why I'm a little bit confused as to what's going on here from the textbook perspective. If it were me personally, okay, I just showed you what I would do, what happens when you retire stock, retire treasury stock as is, okay? You saw me make that entry, all right, from treasury stock to the retained earnings, right? So if I were, instead of combining the two together, if I'm going to sell treasury stock, I would make one entry for the sell of the treasury stock, and then I'd make another entry to retire treasury stock, okay? I would not combine the two together in order to have just one journal entry. It obviously becomes a little bit more complicated, and I personally don't think that's the best way of going about it, because then you can't see, you lose, and like me, I'm a little bit like, what's going on here in the flow of things. So with that said, I realize that this is a bit confusing, all right? And unfortunately, I've spent 30 minutes explaining this, all right, without realizing that that's the way that the textbook is presenting it. So if you have to, go back and watch the video again, all right? All of the pertinent information is there, okay, as to, buying treasury stock, how to sell treasury stock at, at market, at overcost, and below cost, and also how to make a journal entry to retire, right? But and try to kind of like follow along in, watch those particular entries, realizing that, you're going to have an effect on your paid-in capital, and really that's no different than what you had done with common stock and your preferred stock, okay? The only difference being here is with the treasury stock, you're able to buy it buy it from the marketplace, and you're able to sell it back into the marketplace before you decide to retire the stock. And then, of course, retiring, all it is just moving from treasury stock to retained earnings, but you also have to think about the effect on the paid-in capital and make the appropriate entry for that, right? Yeah, it can get complicated in that, like in this case here, they're selling and retiring at the same time, right? But go back and watch the videos again. Definitely work through the homework problems. That will help out, all right? And if you still don't understand what's going on, feel free to telephone or an instructor, and we'll walk you through it. It's not that complicated, all right? This last portion made it seem complicated, but it really isn't if you keep things in a simple step-by-step manner, all right? So if you're not getting it, feel free to contact an instructor, but I suggest that you do the homework problems. Again, it's about understanding the concepts and then applying it to the situation, all right? So I will see you in the next video for reporting.